Hey guys, my name is Max Convexity. Thanks for tuning into my channel. I really appreciate it. Today I want to talk about the top 5 YieldMax ETFs of the week. Now this is according to the MaxFactor. Is your high yield ETF a real MFer? If you've been watching my YouTube channel for a while, you're probably familiar with, or at least heard about my MaxFactor ranking system. So what it is, I rank a universe of 90 high yield ETFs of my choosing. But I take suggestions. If there's any in there that aren't in there that you want me to put in there, be sure to tell me about it. To be considered high yield, the ETF has to pay a minimum of 6%. So I'm not ranking anything lower than 6%. Now I look at this live twice a day on my live stream. So I kind of think of it as fantasy football for ETFs or maybe Moneyball for high yielders. The MF rankings are also published 24/7, updated live on the internet at maxconvexity.eagon.com. I spoke with a friend today, and he advised me to also publish to the just maxconvexity.com. So I'm likely going to publish to that place as well, so you don't have to memorize Eagon. The MaxFactor is a proprietary ranking method. It looks at 4 factors. Okay, the 4 factors are yield, momentum or trend, whatever you want to call it, but call it momentum. Yield, momentum, safety, and total return. Those are the factors it weighs. Ideally, what I want is an ETF that yields a lot, 100% or more, right? With positive price momentum and also with good total return. Oh, and one that's also super safe. Now, that may sound easy, but it's not, because the safety and the yield go opposite directions of each other. So what my metrics attempting for is to identify the ETF with the best mix of these attributes, of those 4 attributes. And most metrics look for the most of something, but this metric is looking for the best. I'm attempting to make it more of a qualitative metric than a quantitative metric. All right, coming in at number 5 is Biggie. Look at that. That's wonderful. This is a target ETF that pays 12%. This is outperforming the SPY. Its holdings are, it has the 50 biggest stocks in the United States, I think. So it's like half the S&P 500, but it's just the biggest half. So it's just a standard growth fund is what I would call this. You have 50 of the biggest stocks in America, and you're selling covered calls on them. Let's see how it's done. So you look, this one, I guess, hasn't been out all that long. Well, I wonder how I came up with 4.8 for a date. Surely it's been out longer than that. Anyway, I did want to look at how the things have been doing over the last quarter specifically. So, or last couple of months. So that's probably why I chose that date. In any event, just over the past couple of months, this thing's up 21%. That's amazing. Now the SPY is up 20%, but that's still really good, right? It's beating the SPY, and it's paying a 12% dividend. It's a target fund, so they just make sure it pays 12%. They only sell enough premium to equal the 12%. So if they only sell enough premium to equal the 12%, that means they aren't overriding the whole portfolio, which means extra upside. Anyway, Biggie's a good one. Number 4 is Chippy. Now, this is a YieldMax semiconductor-based high-yield ETF. This one pays 39%. This is not a target fund. It's unconstrained. It just pays whatever it pays. This is a portfolio of covered calls, and they're writing the covered calls on semiconductors-based stocks. Now, this thing, also looking at the same time period, past couple of months, I mean, look at this. You've got to be freaking kidding me. 37% in a fifth of a year. Total return? Heck yes. I'm spanking the SPY. Anyway, that's wonderful, right? Now, and what I always say, why is the only reason we get these things instead of the SPY? The only reason we might want this instead of the SPY, in my opinion, is for the yield. So what is this? Let's look at the dividends. 362. So this paid $3 worth of dividends in a fifth of a year, right? So that's $15 for a year on something that only cost you $41 to buy. That's more than 33%. That's really good. Anyway, it's 39 anyway. All right. All right. Well, yeah, I like Chippy. Number 3 is Carvana. Now, this is based on Carvana. It's a single stock covered call fund, non-leveraged or anything. This is your basic YieldMax fund. What they do is they own a synthetic that gives them the equivalents, the option equivalents of shares in Carvana. And then against that, they sell covered call spreads, which is where they sell a covered call and then sometimes they buy a call on top of that, making it a covered call spread. Anyway, the yield on this thing's around 100. Now, to be fair, look how risky it was. When the market pulled back, you could see here the SPY was down 10% in March. This thing was down 30% over the same time frame. The SPY was down, now it looks like the SPY went down another nearly 10% and this thing barely dropped, but still, this thing was down 35% or something. So it's risky. But also look at it on the upside. It's just rocketing upward. So 100% yield, that's something else. But of course, 100% yield comes with the cost. The share price has gone from 50 to 41 in a third of a year, right? So at that rate, it's probably going to drop 27 points. 27 less 51 is, what is that, 33 or something like that? So if it goes from 50 to 33, that's about half. We'll call it 40%. But if it makes 100% on yield, keeps yielding 100%, it's going to have a total return of about 60%, right? That's how these things work. The total return right now is only 10%, but it's only a third of a year. So if it kept going like this, it would earn 30%. It's a monster. A lot of these are, but it is risky. That's why you don't want too many of these. I mean, you don't want to get overloaded and find yourself down 30% on NAV. In at number 2 is GPTY. Now, I love this one. This one has 15 to 20 stocks that are in the AI business. It has NVIDIA. It has Facebook. It's basically what I'm going to call it is blue chip tech. Now, this thing is incredible. The yield's about 30%, but let's look. This is almost half a year. The NAV started at 50 and is at 47 right now, 46.90. We're going to round that up to 47. It's dropped $3. It's dropped $3, but it also paid a $5.43 dividend while it dropped $3. So this thing, once again, same warning as the other one. It's risky. Look, this was down 25% in its same time period where the SPY was down about 17%. So you add some risk even with this one, but you could see it's just rocketing upwards and it's beating the SPY on total return over this time period. Number 1 is MSFO. Now this thing pays around a 40% yield, and it's outperforming the SPY lately, but just barely. Look at this. Now, but I went back to since inception, so that's pretty impressive. Over 1.82 years to outperform the SPY. That's pretty good, right? We'll take that. I'll take that. So let's see here. 40% yield, but let's look at that. Let's look at the dividends. They paid a $10 dividend on something that cost you $20. Okay, that's 50%, but the share price dropped from 20 to 17, but I'm fine with that. That's impressive. That is impressive. It's impressive that it paid $10 on an asset that cost 20, whereas the SPY paid $12 on an asset that cost 439 on an asset that costs 20 times as much, meaning the SPY dividend is about 1/20th, given this little quick math I did of MSFOs. All right. You guys happy with that? Do you like MSFO? So let me explain kind of how the MaxFactor works, or what it's trying to look at. I've explained the factors, but what it's using is the process it's using is called technical analysis. Technical analysis is the process of looking at charts and looking at statistics and mathematical quantitative measures to attempt to predict the future. Of course, technical analysis can't predict the future. Nothing can. It can help you spot trends and patterns. And that's why I invented the MaxFactor. The MaxFactor is one of many tools we could look at. You could also use volume profile. You could use RSI. You could use MACD. You could use a jillion of them. Just simple moving averages might work for you also. This isn't the only way to do it. I'm just trying to find a way to mechanically stay in the 5 or 10 best funds. And I needed something like this so I know what the 5 or 10 best funds are. All right, let's talk real quick. The best practices for high yield investing. All right, I'm going to say do not allocate more than 20% of your retirement to high yield ETFs because of the extra risk. Figure out how much income you need to live off of and only buy enough of that fixed income investment to support the income. Don't forget about government bonds, business development corporations, closed-end funds, real estate. Passive income is passive income. This isn't the only show in town. All right, so how much should I buy? So the standard allocation, a lot of retirement planners tell you, you hear people talk about 60-40, meaning 60% stock and then 40% in usually bonds, but it could be fixed income. It could be REITs or something like that. So if you're a high yield investor and you're following my rules of thumb, and remember, these rules are, I'm not a professional. So, but if you're following my rules of thumb, you'd only have a max of 20 in the high yielders just because of the extra risk. You're leaving yourself 20 for other forms of fixed income. Okay. So covered calls aren't the only show in town. Talk to your planner, bonds, just whatever. I'm just trying to keep you diverse, right? A high yield investor that's trying to follow my rules could go 60-20-20 stocks, bonds, other fixed income. All right, guys, remember, this is not financial advice, but I really appreciate you all for being here. Leave me a message and let me know what other ETFs you'd like to see me rank in my MaxFactor. All right, guys, I certainly appreciate you all. You have a great day.